Hello and welcome everyone to yet another episode of Chalo Numbers Samjhe. Real log, real money, real decisions. क्यों? क्योंकि numbers कभी झूठ नहीं बोलते.
So mention. I have a question that so this passive investing or index investing is basically for whom? So for whom do you recommend this kind of investment style?
Yeah, so I mean, I think fundamentally you have to
Vision
not.
is saying for everyone.
Right, yeah.
Yeah, just joking. We mentioned you
That's a good one.
close
Yeah,
a lot
yeah.
of shops, and if you put out your address, everyone's going to come there. Just kidding.
Yeah.
You are follow. You said right that you have started following a lot of fund managers. Now they will start following you. For everyone, where are you located?
Yeah. No, so that's true. I think index investing is not for everyone. I think each person, it's your own money, right? So you need to decide where it makes most sense for you to invest, and it has to sort of suit your overall temperament, I feel, right? So you have to decide whether active investing is closer to your nature or temperament as a person, or if index investing works better for you. So fundamentally, I would say that a person who is, very competitive might have trouble dealing with index investing, right? A person who is more relaxed, right? Maybe a more sattvic person, let us say, right? Will deal with index better. A more rajasic person will have harder time dealing with index. And why do I say that? Is because, index means once you decide that I want to invest in the index, let's say for the large cap space, like Gautam said, right? You have picked a fund, right? I mean, whatever, let's say HDFC Nifty Index or something like that, right? You've picked a fund and you're going ahead. I mean, let's say you do a portfolio review after 1 year, and if you just look at any, if you look at the large cap space, at any given point of time, there are going to be many funds that are beating you and making higher returns than you, right? So if you are not comfortable seeing that other funds are making more than me, more than what I have invested in, then index investing cannot work for you. If you can be bindas and chilled and cool and say that's okay, other people are going ahead of me, that's okay. I'm okay because I know why I made this decision and I'm going to stick to it. Only then, can you do it, right? Because otherwise, if you buy an index fund and then, a few months later or 1 year later, you see others, active large cap funds, let's say, doing better, then and you switch, then again you've defeated the purpose. So you need to be able to stick to it. The other thing is about, I think a lot of people that I've seen are very uninterested in investing, let us say, right? So unlike three of us on this call, we are very excited and interested in investing. So many people are very interested in, art or painting or, music or, like I ride, of course, like riding bikes also. You have a lot of hobbies, you want to do different things, you want to socialize. So if you have a lot of hobbies and you prefer to spend time on that rather than you prefer to spend time on, analyzing mutual funds, reviewing, looking
Making
at data,
alpha.
looking at numbers. If you're not a very analytical person, if you don't like doing all this engineering
Yes.
type of analysis, then
आराम
also
से
this is
बैठो,
good.
enjoy करो, and let money grow
Yeah,
on its own. और
because
grind
otherwise
11
you are, otherwise you're feeling some level of anxiety every time, let's say every year, every 6 months, depending on your nature, how often you're reviewing your portfolio. Every time you're thinking, have I selected the right funds? Is my fund doing well? Is it doing badly? Am I making a mistake? Could I be doing better? Once it is index, all these questions basically disappear automatically, right? Am I doing better? Am I not doing better?
And you have always have that urge to take some action on your portfolio. I've spoken to some people, so they have reached out to me for their help and all. So they are like, so once I have suggested them ki boss, this is the portfolio you should follow, so this is the suggestion and all. So they went ahead, and then again they came back whether this is good or not. I'm like, boss, this is good, perfect. So I sensed that they had urge to do some action on it. Even if they don't want whether that portfolio, that fund is doing good or bad or not, but they want to see some action. Then they think that my portfolio is doing good. They don't understand that, boss. Chalo, theek hai. Even if
Not
it is
taking any action is also an action.
exactly, they don't understand that, and more importantly, they don't understand the tax implication. Even if you have a, let's say for example, they come up with, or I come up with a new fund or anything new, right? That could be better in the long term, right? But already you have funds which are doing good. Why to switch? Why to attract capital gains? So they don't understand that. They just want to see some action happening in their portfolio.
Makes sense.
Right. Yeah. On that, I just want to share one more insight from the US, right? Research done in the US says that some of the most successful investors in the US, when they analyze the most successful investors, the aggregate transactions per year of the most successful investors is about 1.5 transactions per year, right? So the less action you take, the more you do, right? Exactly the point Gautam is making right now, right? A lot of people feel compelled to take some action or make a transaction or make a change, right? If some person will say, I'll only change my mutual fund if the category average is beating. Somebody will say if 5 funds are beating by more than 2%. So everybody has a different threshold and will say, no, but we should take action. Or somebody will say, no, that's fine, I'm fine with it. And the more activity,
at least you're coming, sorry to cut you, Mejan, at least you're coming with some numbers that people are saying ki 5%, 2%. I have heard people that market is falling or market is going up. They don't have any number in my mind. They are just like, Gautam, what to do. Arre, what to do what?
yeah.
Market is moving.
Portfolio to dekho.
Exactly.
No, but that's a good point, right? I mean, and again, I'm just thinking ki, what if somebody listening to this video has a question that I to have an advisor, and that advisor is, let's say, getting me all the active funds and getting me a decent 13-14% return or a 12-13% return, then should I still stick to that advisor? I mean, let's say the person is the same exact, enjoys hobbies, wants to chillax, relax, and right now the person has put all this pressure onto the advisor. So now this person, how does this person choose between going with the advisor who's still getting him a 12-13% return versus doing everything, fitting to the index? And should they not? And what are the kind of thoughts that one?
I have a very simple answer to that, right? The simple answer is that they should keep the advisor honest in terms of measuring the performance of each of the funds in the portfolio against its benchmark once a year, right? So if you have 10 mutual funds, check each year how many of those 10 funds have beaten the benchmark. If more than half of them are consistently beating the benchmark, you just stay with the advisor. He's a fantastic advisor. But if the moment it drops below half, the value of the advisor is questionable, because you could have just chosen an index fund and without paying any fees, you could, more than 50%. So yeah, of course, not only the number of funds, I would say the asset weighted number your asset weighted number should be more than 50%, right? Because if you have, let's say you have
sorry, I didn't get that.
No, so what I mean is, like, if you have, let's say you have 80% of your investments in large cap, right? And only 20% in mid cap, right? So even though you have only, let's say you have only 2 funds for simplicity, right? You have only one large cap and one mid cap, but 80% of your money actually is in the large cap, and the large cap is underperforming the index. You might say, well, half and half, and the mid cap is beating, right? So mid cap is beating, but only 20% of your money is beating the index.
Oh, okay.
80% of your money is not beating the index, right? So
basically 80% of your money is not working at all.
Is not
So
beating
whatever
it.
the working in portfolio is being done by 20% of your money. That's it.
Correct.
Yeah. So I think if you just do that, and then watch it year after year, you can decide. I mean, there are genuinely very good financial advisors available, and many of them are.
And one more point to add here, Akshat, so obviously benchmark is the one thing. What I have observed while doing all this data analysis and all, that at some point, schemes, most of these schemes, active schemes, they have been beating benchmark. But another point, people don't, when it comes to investing through advisor, right? So people don't compare their investments with peer or the category average, I can say. So let's say, for example, your fund has been consistently has been able to beat the benchmark, or most of the funds have been beating the benchmark, right? But what if your fund is in the bottom quartile, right? And you are investing through the advisor. Then again, in that case, advisor's capability or whatever you can say is again questionable. That boss, you are beating benchmark, but what about the other funds in the same space? Your recommendation is not beating.
How can I check this? I mean, is there a tool or something that I can use? I mean, maybe you guys can guide me right here itself. I can open it up.
I think value research is there. I'm not sure, Mejjan.
Yeah, that's what we just.
It's there in advisor coach, but Mejjan will guide you in value research.
Yeah, value research. I'll open it up. Give me a second. That's an interesting thing. We can maybe have our viewers look at it as well. Yeah. Okay, so I'm at value research, and if I go to funds.
Yeah, funds.
And
then scroll right to the bottom, maybe. Yeah.
This one?
I think it was there, right? That you fund more under a category, and when you click the category,
now it came.
Compared to benchmark, huh?
Yes.
Yeah. Okay. So this is basically the equity large cap, for example, in comparison to the BSE 100 total return index. Okay, so the entire large cap to the entire.
Yeah, the entire. So this basically tells you the entire universe, basically large cap universe, how they have performed. So vis-a-vis to the benchmark, basically.
My goodness, this is true, right? Whatever we've discussed so far, so the equity large cap category ka average is 12.61%, and I'll increase the size, right?
Yeah, increase the size.
It is 12.61%, and the BSE 100 ka TRI is
14.05. Clearly, what Mejjan has been talking about. See here.
Large and mid cap. No, sorry.
And it is tying in with the number I told you for my own portfolio return, right? 10 years, I told you
14%, correct. Yes.
Exactly. That is exactly because I am on the index, right? So
if I look at mid and large cap wala, isse mid large cap index, so this has gotten slightly beaten. I mean, 14.62 is the industry average, 14.31 is, and pretty much same.
That too slightly outperformance.
Then Flexi Cap has been beaten, 14.66, BSE 500 total return index. So Flexi Cap has been beaten by almost 1.2%.
Yeah, but there is a caveat there. I mean, I'm not 100% sure about this, but I think one has to look carefully because Flexi Cap is benchmarking against BSE 500. So BSE 500 is completely as market cap weighted, right? If obviously in the flexi cap category, a fund manager will have some significant advantage because he or she can highly overweight compared to the benchmark by adding much more percentage of mid caps or small caps, right? So I'm not sure about this, but I just have some doubt. It needs to be analyzed whether that is truly the best benchmark.
Right, but what I'm saying is even if the fund manager does that, the fund should be beating the benchmark, right? But it's not.
That's what, correct.
It's not beating.
It's
not beating actually, it's opposite.
Oh my god, really? Oh, I didn't realize that. Okay.
You have the flexibility go overboard in mid and small cap, and let's assume you are, but still you are not beating the benchmark.
14.66% versus, so 14.66% is the SE 500
benchmark
versus point.
Okay.
And I'm looking at only the 10-year data, right? I mean, obviously.
10 years.
Multi-cap my goodness, mid-cap has also been beaten. 18.16 is the benchmark and it's 16.25 as the category average.
My god.
So small cap has not been beaten. Oh my goodness, this is crazy. Value oriented is pretty much same, and then so on and so forth. Then the individual indexes. I think the individual, the sectoral funds have the active ones have performed better. But उसमें भी सारे नहीं है. उसमें भी the auto one, the index has performed better. Banks maybe index has performed better. Healthcare में active has done fine. IT में active has done fine. And then this is what this is the thematic in general. My goodness, this is eye-opening.
Yeah.
Wow. And even
now I got my answer actually.
Huh?
For whom index investing is there for everyone.
Yeah. But
No
so I'm,
nonsense.
not to sound like a fanatic, right? But I'm going to just share one or two other pointers for you all, right? So one is that Warren Buffett himself has at least 3 or 4 times in the last 20 years during his shareholder meeting said that the best route of investing for the average retail investor who is not willing to spend dozens and hundreds of hours analyzing data is to simply buy the S&P 500 index. And the statement that Warren Buffett has made in this context, right, is he says, and you can Google it, it's easily available. He says, a person who simply does a 10-year SIP in the S&P 500 index will beat 90% of all investors, including professional investors. So, when I heard that also, that made me feel more, given that he's my absolute guru, I made that index. Right? The second point that a lot of people don't know is that Warren Buffett took a bet. I forget the year in which, maybe 2013, I forget the year. He issued a public challenge and said, I challenge any hedge fund manager to take a $1 million bet with me, right? And beat the index over a 10-year period. So this is not Warren Buffett against the hedge fund manager. This is S&P 500 against hedge fund manager. But Warren Buffett is saying, if you beat the index, I will pay you $1 million. If you don't, you have to pay me. The hedge fund manager put 5 hedge funds in that basket. Okay, not one of the 5 hedge funds could beat, and within 9 years he gave up and he gave Warren Buffett $1 million. Right?
Oh my goodness!
So
Wow.
there is data. Of course, yeah. There could be. The thing is that there is validity in the point that it's possible that today in the mid cap / small cap space there is some what they call market inefficiency
Just Googling
that
it
allows for it. But you should keep looking at the data. Is all I'm saying. So my point is, know that this is how the mature economies have progressed and the trajectory they have taken. We may not be there yet. There might still be some room left for us to, extricate alpha, as they say, from the markets in mid cap, small cap, etc. But keep monitoring. I think so. My most important point is, you don't have to become a fanatic or this thing like me, evangelist like me about index fund. But you cannot lose the discipline of saying, let me benchmark against the index, let me benchmark against category, as Gautam said, right? Once a year, that is a non-negotiable thing, even if you have the best financial advisor in the world, right? I think you have to check that.
Makes sense. And what do you do with your debt funds? Debt funds where there's nothing index, right? So,
There are some debt index funds, but there is a lot of ambiguity around whether they are really good to invest in or not, right? So, I have a lot of debt funds which are all short term, and like I said, I got into corporate bond funds, right? So I do have that. I have almost.
These are all Indian corporate bonds, or these are global?
Yeah, absolutely. Indian AMC offered corporate bond funds. I think.
So any guideline or any what's your approach on selecting the debt funds? Any thoughts on that?
Yeah, I think in this case, I follow Dr. Bernstein's approach, which is to say he recommends short-term funds because the duration risk is less, right? The moment you add large, like if you go into gilt funds or long duration bond funds, you are adding the interest rate risk issue, right? So I stick to short, and he says, average maturity, etc., should be between 3 and 5 years. So I make sure that the average maturity is 3 to 5 years.
Okay.
And I just simply go to value research and pick a fund based on their star rating, and just look at a little bit of the history, etc. Not that much to be done. Or I look at what value research suggests on their fund advisor and stuff like that. So,
and one more quick question. So the large cap index investing, right? Now, how do you choose between like various AMCs out that are out there? Any particular way of selecting which AMC to go with?
I think I started with taking the one with the lowest total expense ratio, right? TER, right? But I think one can be fairly flexible by looking at. I personally like to go with a well-known fund house. So, for example, I like SBI, right? I like HDFC. So, choosing a large, well-known fund house is my personal preference, but I don't know if that's a good rule to follow.
Okay.
So expense ratio and AMC. AMC's reputation overall, right?
And then I think Gautam also keeps talking about uh,
Tracking error.
tracking error. Tracking error.
Oh yes,
So,
correct. You're right about
yes.
that. But frankly, I haven't looked at it. But yeah, that's true. You should look at it. That's true. Yeah.
So I only look at tracking error. That's it. So because Meshjan, I think while calculating tracking error, this expense ratio is already taken care of. So even if let's say two funds are there, so fund A whose tracking expense ratio is higher than the expense ratio of the fund B, but the tracking error if it is low, so so basically in index investing, what is the idea that you should match the performance of that index as close as possible, right? So what does tracking error tells us? So lower the error, better the closeness of that fund is with its index, right? So in the computation of tracking error already this expense ratio is taken care of.
Correct.
So I don't look at actually total expense ratio. I simply see the total tracking error, the least better it is.
Right.
So maybe I'll combine both of yours and do it. I'll take tracking error, I'll take TER, I'll take the good
Fund house.
EFCs, and I'll come up with my index funds.